March 10, 2000. The NASDAQ hits 5,048.62. In a midtown Manhattan office, a 52-year-old retired teacher stares at her screen. Her $800,000 nest egg, poured into pets.com and Webvan, is about to vanish. She whispers, "They said it was different this time." Within weeks, margin calls wipe out her account. She is one of millions. The promise was seductive. The internet would rewrite all business rules. Startups with no profits, just eyeballs and clicks, were valued in the billions. Venture capitalists pumped in $100 billion in 1999 alone. The mantra, get big fast or get left behind. Traditional metrics like earnings were dismissed as old economy thinking. Investment banks like Goldman Sachs and Morgan Stanley turned IPOs into a high-stakes lottery. In 1999, 457 companies went public, many doubling on day one. Banks allocated hot shares to favored clients, hedge funds, and insiders, who flipped them for instant profits. Retail investors were left buying at inflated prices, chasing a dream sold by CNBC and chat rooms. To keep the party going, companies cooked the books. A little-known fact, MicroStrategy, a software firm, used pro forma accounting to report revenue before it was earned. In 2000, it restated earnings, revealing a $66 million loss instead of a profit. Its stock collapsed 62% in a single day. Dozens of firms used similar gimmicks, barter deals, round-tripping, to fabricate growth. While the public bought in, insiders sold out. Between 1999 and 2000, corporate executives dumped $66 billion in stock. At InfoSpace, founder Naveen Jain sold $200 million of his own shares months before the crash. Employees, locked into company stock in their 401(k)s, watched their retirement evaporate. The asymmetry was brutal and legal. April 3, 2000, Judge Thomas Penfield Jackson rules Microsoft a monopoly. The NASDAQ plunges 7.6% in a day. It's the first domino. Over the next months, the Fed's rate hikes and a string of earnings misses shatter the illusion. By December, the index is down 50%. Pets.com, a poster child, goes from IPO to liquidation in 268 days. The human cost was devastating. Margin debt had tripled to $278 billion. When stocks fell, brokers issued margin calls, forcing investors to sell at the worst moment. In San Francisco, a 38-year-old software engineer who had borrowed $200,000 on margin lost everything and took his own life. Support hotlines saw a surge in calls from ruined day traders. Wall Street analysts, meant to be watchdogs, were cheerleaders. Henry Blodgett, Merrill Lynch's star analyst, privately called a stock a piece of junk while publicly rating it a buy. Later, emails revealed the deception. In 2003, 10 banks paid $1.4 billion in settlements. But the damage was done. Trust in the system was shattered. The dot-com crash exposed deeper frauds. In October 2001, Enron, a supposed new economy giant, admitted to hiding billions in debt. Its stock went from $90 to 26 cents. Then, in June 2002, WorldCom revealed a $3.8 billion accounting fraud, the largest in U.S. history. These scandals sent the market into a final tailspin, erasing $7 trillion in total market value by October 2002. Amid the wreckage, a few companies endured. Amazon, founded in 1994, had gone public in 1997 and saw its stock crash 95% from its peak. But Jeff Bezos stuck to a long-term vision, investing in infrastructure. By 2002, it turned its first profit. Others, like eBay and Priceline, adapted and thrived. They proved the internet was real, just not at any price. The scandals led to the Sarbanes-Oxley Act of 2002, imposing strict reforms on corporate governance and accounting. Executives now had to certify financial statements. The law cost billions to implement, but restored a measure of confidence. Yet, the fundamental lesson, that bubbles are fueled by greed and willful blindness would soon be forgotten. The dot-com collapse taught a brutal lesson. When promises outpace profits, disaster follows. But within a decade, the same patterns re-emerged in the housing bubble and cryptomanias. The retired teacher never recovered her savings. She now says, "I learned that if it sounds too good to be true, it will destroy you." The question is not if the next bubble will burst, but when, and who will be left holding the bag.